Until we confront the real source of this crisis, the Federal Reserve's unchecked ability to print, manipulate, and devaluate the currency, families will continue fighting a battle they cannot wield with tools they do not control. Think about this today. Think about this on the day where we are looking at what the Fed is going to do. Let's understand what's behind this caption, right? So we need to confront the truth that almost no one in Washington, on Wall Street, or even in the financial media is willing to say out loud a truth captured perfectly in the lines you're seeing on your screen right now. Until we confront the real source of this crisis, the Federal Reserve's unchecked ability to print, manipulate, and devaluate the currency, families will continue fighting a battle they cannot win with tools they do not control. This is not an hyperbole, right? This is not a conspiracy. This is the structural reality of the American economy in 2025. And if we do not face it directly, the next decade will look like post-war prosperity and more like a slow-motion erosion of American household wealth. What do I mean by that? Well, first of all, the word unchecked is the entire history. The Federal Reserve was created with a dual mandate. You need to understand that. First, stable prices and maximum employment. But over the last decades, 3 decades actually, the real mandate has evolved into something entirely different. Stabilize asset prices at all costs. Meaning, let's make sure the stock market doesn't crash. Why do you think the administration was after our dear friend Powell to make sure that he was checked and he kept lowering rates? Support government debt issuance at all costs and intervene directly or indirectly whenever the financial market trembles. So, that is not their mandate. Their mandate is not to make sure the stock market keeps going up. That is not the mandate. The mandate of the Fed is stable prices and maximum employment. What they mean by stable prices, they're not talking about the stock market price. They're talking about inflation. And they talk about employment. So the line in the attachment calls this out unchecked ability, because the truth is no elected official can veto a Fed balance sheet expansion. No voter can block quantitative easing. And no congressional hearing can prevent rate manipulation. The Fed holds the monetary steering wheel, and everyone else, families, savers, business, are passengers. So what do we mean by print, manipulate, devalue? That's not a rhetorical statement. Let's make this concrete. When the Federal Reserve expands its balance sheet, it isn't physically printing dollars. That's not what it's doing. But the effect is identical. The supply of dollars increases far faster than the supply of goods and services, meaning there's too much money hunting too few goods. So this is the mechanical definition of currency debasement, meaning the dollar is getting weaker because you print it all the time. You need to understand that. Your dollar is not worth what it used to be because they could do whatever they want to do by quote-unquote printing it. But they have no choice. Why? Well, because they owe you $37 trillion. What happens when, you can't refinance? How are you gonna refinance? When you suppress interest rates artificially, right, you distort mortgage markets. Your mortgage is based on the 10-year yield. Equity valuations, corporate debt issuance, and the risk premium on everything from junk bonds to tech IPOs. This is not free market pricing. It is administered pricing, monetary policy deciding winners and losers. So for the American family, here's what that means. It means that your saving account earns 0.5% while your grocery bill rises 8%. Your wage grows 2% while asset prices inflate 10 to 20%. Who's making money right now? Who is making money right now? The so-called quote-unquote rich. They're the one making money right now because of that. You gotta wonder, what's driving them. Okay. So the family is fighting a battle with tools they do not control. For years, this is not new, right? But the consequences are now unavoidable. For years, policymakers said the quiet part out loud. Inflation is too low. Higher prices are good for the economy. A little inflation helps reduce the real cost of government debt. Think about that. Inflation, something that directly erodes your saving, is portrayed as a policy success. What changed in the last 4 years is simple. Well, the reason I'm able to say that, because we obviously think that 3% is okay. Right? That's a goal. What changed in the last 4 years is simple. The inflation genie left the bottle, and it's not going back without a fight. What does that mean? It means that the inflation is out there. And I think they realize that we have to live with some amount of inflation. In the past, it was zero, right? Now they're saying, well, let's get it out there. So that is a problem. Now, obviously, we need to realize that this is not always going to be the case, right? This is all going to be the case. But what changed in the last 4 years is simple. The inflation genie left the bottle. Why? Well, because the Fed spent a decade treating monetary stimulus as a one-way ratchet. Rates could be cut, but never normalized. The balance sheet could expand, but never fully shrink. Markets could be supported, but never allowed to clear. You're getting involved. The result is a system addicted to easy money and a central bank trapped in its own past decision, meaning that you cannot allow the stock market to crash. You've got to keep lowering rates. Right? But is this a real rate? Or is this you enticing the market to do so? Now, keep in mind that today, what the Fed is going to do, they're going to work with the Fed fund rates. And technically, this is not a rate that dictates anything that you do on a daily basis. It's basically the Fed fund rate is a rate that allows banks to borrow with each other. The thing is, it sets the tone for the entire market. And they decide that, this is what we think is happening, and therefore we think that with this type of rate, it should fix it. Whatever it think, what we think. When we say we, there's a bunch of people involved, and I'll show you the charts. So the real cost, American families are playing a game they cannot win. Every American household is living inside a monetary system where the rules are set by an institution they cannot vote for and cannot opt out. And the administration tried to control the Fed, and you see what happened, right? So basically going after the guy, going to visit him, going online, making all kind of statements, going after the members of the Federal Reserve Board. That's what it takes to control these people. Families saved in dollars, families borrow in dollars, families are taxed in dollars, families are paid in dollars. So when the Federal Reserve weakened the dollar through policy, even unintentionally, families cannot protect themselves unless they have access to sophisticated financial tools that most Americans do not have. right? They do not get to buy treasury inflation swaps. They do not get to hedge with commodities futures. They do not get to issue debt at 0% and buy asset at 15%. They do not get the elite menu of protecting tools that wealthy have. They fight inflation with wages, meaning that I need to get more money. I'm going to quit my job to get more money because inflation is up. And of course, if a bunch of people do that, then the job themselves needs to pay more money, and therefore inflation keeps on fighting. They're fighting inflation devaluation with checking account. They fight monetary distortion with household budgets. It's a fight they will never win. So when currency loses stability, everything else follows. When the currency becomes unstable, housing becomes unaffordable. Have you noticed? Food becomes unpredictable. Have you noticed? Healthcare becomes detached from reality. I'm sure you've noticed that. And asset bubbles inflate, burst, and inflate again. That's what we're watching on this channel. When is this bubble going to burst? It's not going to burst now, but we need to watch for the sign. We definitely need to watch for the sign. The middle class is shrinking. This is not an accident of capitalism. This is a predictable outcome of monetary interventionism. You're getting involved in something you shouldn't. Milton Friedman was the most respected economist of his time. And you know what he said, what the role of the Fed should be? Just print money, just basically print money and create liquidity when there is. Create liquidity when there is a need for it, and reduce the liquidity when there is no need for it. That's all you should be doing. You shouldn't be playing with rates. Families do not control the currency that defines their entire economic existence. So if Washington truly wanted to help American families, the debate would not be about stimulus checks, tax rebates, or tax refund. It would be about monetary reform, transparency, accountability. That debate never happens because acknowledging it would require admitting the entire system is fragile by design. Let's keep in mind, 2008, the Fed missed the ball, right? They didn't see it coming. In 2021, 2022, the Fed missed the ball again by thinking that inflation was just transitionary and they didn't do anything with the rates. So if the Fed maintains its current model, what's going to happen next? The long-term path is clear. Short period of stability right now. Market's going up, right? The Fed's going to lower the rates. Great. Followed by disruptive inflation shocks, followed by politically pressured rate cuts, followed by asset bubbles, followed by market correction, and followed by new interventions. A perpetual cycle of artificial boom and painful bust. Families become spectators in a game run by institutions whose incentives do not align with household stability. This is why the line in the attachment is so powerful. We cannot fix cost of living crises without addressing the monetary system that created them. So the final message is this. This is a moment for honesty, right? As we await the news of whether or not we're going to have rates that are going to be cut. So here's the blunt truth here. Until the Federal Reserve power is rebalanced, until monetary policy is transparent, accountable, and constrained, until the dollar becomes a stable store of value again, American families will continue fighting battles they will never equip to begin with. This crisis is not temporary. It's structural. And it begins not with politics, not with supply chains, not with tariffs, but with the Federal Reserve, unchecked authority over the value of every single dollar in your pocket. If you want real solution, we must be willing to name the real problem. And that's it. So think about that for a second. Next. What do you think will happen if the Federal Reserve has to default on interest payment on the debt? It is getting to the point where interest payments are closing the gap. We owe $37 trillion. That's a good question. We owe $37 trillion, right? And that debt, and this is not me saying it, it's a Fed. Powell said the debt is manageable, but it is not sustainable. As long as the US is able to print, like I said before, is able to print dollars, it will keep refinancing the debt with new debt. Okay? And unfortunately, as you're doing that, you're debasing the currency. But then again, the dollar is what you call a reserve currency. You need the dollar everywhere in the world. For now. Keep in mind that the administration is fighting a battle right now. And the battle that they're fighting has to do with keeping the US relevant, i.e., we want you to keep using the dollar, i.e., we want you to keep making sure that you have items for us to buy with the dollar. Right? You want our dollars. What do you think, the administration, the current administration basically told the entire world, if you want to do business with us, you're going to do, if you want to basically have lower rates or lower tariffs, then, and you want access to the US GDP, which is 25% of the entire world, then you got to use the dollar. Meaning by the dollar is you got to sell us stuff and we'll give you dollars. It's a privilege. It's an advantage, right? It's a luxury. We're allowing you to have dollars, so sell us stuff, but not at 50% tariffs, at 10 to 12% tariffs. We're going to tax you, right? We want your dollars. But be careful. Because frankly, if you're China right now, they could say, listen, I don't really need you guys anymore. Right? It's a danger. I could do business with India. I could do business with Russia. I don't need the US. I mean, they're not kind of saying that right now, but at some point they won't need the US. They could produce everything they need. Right? The US, on the other hand, needs China. What do you think the administration is fighting like hell to say, well, we've got to build some stuff here, people? Because soon, because we have such a huge trade deficit, no one is going to sell us anything. That's going to be a problem. If we don't make our own production, we're going to be dependent on the entire world as long as they want the dollar. But when they start selling to each other, you're going to lose your power little by little, or your GDP is going to become less and less and less relevant, and then they'll trade with each other, and then you're done. What do you think BRICS is all about? Right? BRICS is it's an open battle to the dollar. BRICS, Brazil, India, Russia, all these people are going to get together. They don't need you. They don't need the US anymore. That's the danger. Slide number 1. Let's take a look at slide number 1. And that one is quite interesting, I must say. So here, what we have is what we call, give me a second here. Okay, so on ordinary yield moves, what this chart really means. Take a look at this chart. So let's break down one of the most important, most misunderstood developments happening in the US financial markets. The extraordinary divergence and behavior of long-term treasury yields relative to the Federal Reserve policy rate, right? Because you've got two rates out there. You've got the rate of the stock market, right? Which is basically the rate that is set by the Fed, Then you have the real rate. When China decides not to buy treasuries anymore, the rate goes up and the price of the treasury goes down. What's going on? Look at this chart. Look at it very carefully. The straight line is the Fed doing its thing, and the the mountain, the blue line going up and down is basically the market. That's also a rate, and that's the rate that you are paying your Federal Reserve, your debt, your $37 trillion. So basically, the most important, most misunderstood developments happening in the U.S. financial market, the extraordinary divergence and behavior of long-term Treasury yields relative to the Federal Reserve policy rate. So we see a chart titled Unordinary Yield Move, right? Compares two lines. The blue line, the U.S. 10-year Treasury yield. The green line, the federal funds rate upper bound. This chart runs from September 2023 through September 2025, and it highlights a pattern that is not supposed to happen under normal monetary policy frameworks. Not only did the 10-year Treasury fall during rate hikes, but it rose sharply following major rate cuts by the federal government. Let's talk about what this means. Because the rate that you need to worry about is not the Fed fund rate. It doesn't impact you at all. It doesn't impact you at all. But the Treasury rate, that impacts your mortgage, for example. That impacts how much it costs to pay that $37 trillion. So let's take a look at it. And let's see what it signals for the economy, inflation, and markets. So the federal fund rates, which is basically the rate that is charged among banks, now again, nothing to do with you, it remains relatively stable through much of 2023 and early 2024, holding at a very restrictive levels. Meanwhile, the 10-year yield starts near 5%, but falls significantly into late 2023 and early 2024. This is the first unusual behavior. Typically, long-term yield rise when the Fed Reserve raise rates. All the rates are going up. And they fall, when the Fed cuts. Isn't that supposed to happen? That's a classic reaction function. Tighter policy pushes long yield up, and looser policy pulls them down. But we see the opposite here. What's going on? It's a mystery. In early 2024, long yields declined towards the mid-3% range, even though the Fed is holding rates at about 5%. 5%, 3%. Of course, the Fed was holding the rates so high because they were fighting inflation. Later, after the Fed begins cutting rates, and again in September, as we've seen, and again today in December, 10-year yield rises in response. Now, the 10-year yield that you need to worry about, that's your mortgage rate, okay? So those purple arrows drawn on the chart emphasize the major upside reversal, as you could see in the 10-year yield, both of which occurred after the rate cuts. This is not normal behavior, and this is why I want my subscribers to understand. It requires an explanation noted in expectations, supply shocks, fiscal dynamics, and the market belief about the long-term neutral interest rate. So why, and this is the interesting question, why did the 10-year yield fall in late 2023? The drop in the 10-year yield towards roughly 4% reflects a temporary market belief that the Federal Reserve had achieved a soft landing, no problem with no recession. Investors were pricing in rapid disinflation, a weakening labor market, expectation of aggressive rate cuts, and reduction in terms premium. Remember last year, everybody was saying, we're going to have a recession. We're going to have a recession. The world's going to collapse. All the pundits out there were saying that, right? So the key point is this. The interpretation turned out to be overly optimistic. Inflation did not sustainably break lower. Fiscal deficits remain extremely elevated and Treasury issuance surged. The market began reassessing how long-term rates could truly go into a structural higher inflation world. So we had both kind of inflation and potentially recession. In early 2024, the drop in the yield was a mispricing driven by premature expectation of monetary easing. Early 2024 we're talking about, remember, right? That was last year. And it didn't happen. So the 2024 rate cuts and the surge in long yields, basically the surge in the 10-year yield followed the Fed cuts in 2024. This is where the chart becomes extremely important. When the Fed cut the rates, the 10-year yield did not fall. Instead, it rose sharply. What do you think? That yield, what's pushing the yield up, is because people are selling treasuries. The market interpreted the rate cut as inflationary. This is not good, right? You shouldn't be cutting, the market is basically, you shouldn't be cutting rates. This is going to create inflation. Meaning the dollar that those bonds that I'm holding are not worth anything. So I'm selling those bonds. So whenever the Fed eases and the economy is still experiencing high normal growth, it risks reaccelerating inflation. Investors demand more yield as inflation expectation firmed. If you want me to hold dollars, meaning treasuries, I want to get paid more. Why? Because you have more inflation. The goods that I'm going to be buying are going to be worth less and less. So you got to pay me more for holding treasuries. Reason number 2, the U.S. government's borrowing needs exploded. The Treasury needed to issue hundreds of billions in new debt. That huge supply put upward pressure on long-term rates, independent of Fed policy. Why did the Fed? They got to refinance it. Their needs are always, more and more and more money. And of course, reason number 3, the term premium repricing. For years after the financial crisis, term premium was negative. But in 2024, it surged positive as investors finally demanded compensation from long-term inflation and fiscal uncertainty. Meaning that, you have a lot of uncertainty in the ability to maintain $37 trillion worth of debt. I want to get paid for that risk, because you're becoming riskier as a country. And of course, you don't have inflation under control, as we could see with food prices. Reason number 4, the Fed put died. Market realized the Fed could not cut aggressively without reigniting inflation. That meant long-term yield would remain structurally higher even though the rates have declined. The rate that you have to worry about is the Treasury yield. Result, rate cuts led to higher long-term yields because the cuts were seen as too early and too inflationary. Reason number 4. Why the yield remained elevated through mid-2025. Even after the spike, the 10-year yield remained volatile but elevated. Well, persistent inflation. Inflation is a mean, you know what? Strong wage growth that kept the Fed cautious. So when people are still working, they're making money. They want to get paid more. Strong wage growth. Federal deficits remain above 6%. You don't have your house in order. And large-scale reissuance of long-term debt treasury. The same thing. The same thing is happening. More importantly, the market began to believe that the neutral interest rate, the so-called R-star, was significantly higher than the Fed had previously assumed. Instead of a neutral rate of 2%, the market began pricing something closer to 3 to 3.5. So if the neutral rate is higher, long-term yield must be higher. The second surge after the 2025 rate cut, it happened in September. In September rate cut, finally when we got everybody in order and they say, it's time to lower rates. Once again, the yield falling, the 10-year yield moves upward from roughly 4.6% and above 5%. This tells us something very important. Now remember, the Fed fund rate is here, and the Treasury yield is here. So the bond market believes the Fed is behind the curve on and easing too soon. Meaning that Now, why is easy meaning lower rates? Why is the Fed lowering rates? Well, because I guess the administration is after them saying, you know what, you got to lower those rates. And they say, well, maybe you shouldn't be listening to the U.S. administration. Maybe you should make sure that you do your own analysis and realize that maybe the economy is not dying, and therefore we don't need more stimulus. You're going to create inflation. What do you think is happening? Do you think that the Fed is actually in control? Now, forget, when we're talking about the Fed, you're talking about 7 of these people deciding. You got Powell that wants to lower the rates, and you got 2 of the people that Trump appointees, they want lower rates. The Fed is like this. They got this new guy they brought in. Out of the 7 people, it's like a mix right now. And Powell is out. So rate cuts were interpreted as a political move, meaning I gotta get this guy off my back. A concession to recession fears that never fully materialized, meaning that, but last year you were telling us you're concerned about you're concerned about recession. You're wrong, and a weakening of the Fed anti-inflation credibility. You have no credibility. The Fed is losing its credibility, basically. So basically what the chart is telling you, the Fed is cutting, but we don't trust that inflation is contained. We want more yield for the risk of long-term inflation. This chart is pretty simple, really. Look at the little line, the little green line. Look at the blue line. The market is saying, no, we don't believe you. We don't trust you. You don't have your house in order. You don't have your house in order, and I don't think you can control anything. You're not master of your own domain. This is a second unordinary yield move. Cuts create upward pressure instead of downward pressure. So what does this mean for the economy? Well, first of all, and this is what you need to understand, is the mortgage rate stays high. Even with short-term rates falling down, the 30-year mortgage remains uncut at the 10%. That means that limits housing activity and affordability. So the Fed is out there, but guys, I'm lowering the rates. What do you want from me? And you're like, well, rates are, you're going to hear all today, rates are going down. So you're going to say, this is great. My mortgage is going to go down. Now, look, it's not happening. 2, corporate borrowing costs rise. Companies refinancing debt face significantly higher costs, particularly in commercial real estate, high yield credit, and private credit portfolio. This is important. Whatever the Fed is doing, the market, when I mean the market, I'm not talking about the stock market, I'm talking about the credit market, I'm talking about the treasury market, because that's where they set the tone. That's how you pay your bills, technically. They're saying, no, we don't believe it. The rate should be higher. Because you're creating inflation, I want to get paid for it. And of course, if you're a corporation, which when a couple of years ago, you refinance at very low rates, now all that debt is coming down to maturity after a couple of years, 3, 4, 5 years. It's time to refinance, and now the rates are higher. It's going to cost you more. Companies refinancing debt face significantly higher costs, particularly in commercial real estate, high yield credit, and private credit portfolios. Federal interest rate expense climbs. The U.S. is forced to refinance maturing debt at a much higher rate, accelerating fiscal deterioration. Equity valuation face pressure. A higher discount rate, right? Because now you're competing. Do you want 5% risk-free, or you want maybe a 10% in the stock market? A high discount rate compress price to earning multiple and reduce the present value of future cash flow, as we all know. And of course, inflation risk premiums is embedded, and it keeps going higher and higher. Once inflation expectations rise and become sticky, it's extremely difficult for the Fed to push yields even lower. So what does this mean for 2025 and 2026? This means volatility is likely to continue. Bond markets becomes harder to predict. Risk parity strategies become more fragile, and equity market loses their traditional tailwind from low yields. In short, the easy money era is over. We are entering a regime where yields behave in unordinary ways because the macro structure of the U.S. economy has fundamentally changed. So take a look at this chart. Understand this chart and see what happens today, because that, my friends, is a doozy. It's called the dot plot. And let's see if we understand what's going on with the dot plot. So when you talk about one of the clearest signs of that monetary policy is heading into conflict. Why do I say that? Because the chart you're looking at right now shows something the Federal Reserve absolutely does not want to admit. And basically, the market has stopped believing the Fed's long-term rate projections. This attachment is a side-by-side look at FOMC participant projections, the famous dot plot. Look at it, right? Look at it. And basically, it would seem to imply the attachment is a side-by-side look at FOMC participant projections. That's what we call the famous dot plot versus market-implied rates from the 30-year Fed Fund futures. You know, what the market is expecting versus what's actually happening. So this chart is the closest thing the financial world has to a psychological X-ray of the Federal Reserve. What's really going on in that house? It exposes internal disagreements. It exposes credibility issues. And it exposes where traders believe the Fed will be forced to go, regardless of what policymakers promised publicly. So let's break it down. Let's take a look at it. Let's understand it. The green dots that you're seeing, the green dots, right? What do they represent? So take a look at the green dots. And every dot is one policymaker telling us, this is where I believe the federal fund rates should be. But what matters is not just the dot, it's the spread. Look at 2025. Some policymakers are still projecting rates north of 4%. Others are already down to the mid-threes. One or two even dip below 3. This is not consensus. This is not clarity. This is a divided Fed. And that division has consequences. When the experts disagree this sharply, the market doesn't know which subgroup to price. You know, what are we pricing? Are we pricing for 3%? Are we pricing for 5%? It does not know whether inflation hawks will win the internal war or if the doves will take control. Now look at the red line. That red line cutting through the chart. This represents the median projection, the Fed official guidance, the central tendency. In 2025, the median sits roughly around 3.6%. In 2026, it drops below 3%. In 27-28, it drifts just above or around 3%. So the Fed is signaling a slow glide path back toward neutral, but not all the way to the nearly 2.5% they used to talk about years ago. And then there is the blue line, the market view. This is the rate traders are betting on using future markets. This is the real-time vote of money, risk, and probability. And the blue line tells a very different story. So what is it saying? Well, basically, there's a gap between the Fed and the market. To understand the tension here, pay close attention to how the blue line, market expectations, sits below the red line in multiple years. In 26, 27, and especially the longer run, the market is effectively saying, we don't buy your projections. We don't believe the economy can sustain those levels. And we don't believe inflation will force you to keep rates this high. Again, this topic about inflation, that inflation is here to stay. This skepticism is not new. Markets have doubted the Fed before, but the magnitude of the disconnect is what is unusual here. The Fed is projecting a larger run slightly above 3%. Markets are pricing somewhere closer to 2.5 to 3%, a meaningful gap in the world of interest rate policy. It means that traders believe one or two things. One, the economy is structurally weaker than the Fed admits, and a higher natural rate is unrealistic. And two, something will break. The financial system, the labor market, or credit condition, and the Fed will have no choice but to cut more aggressively. Either way, this is a vote of no confidence in the Fed's soft landing narratives. So why does a 2025 cluster of dot matters? Well, let's focus specifically on 2025. This is the cluster that matters for markets right now because rate decision in 2025 will directly influence everything from equities to housing to the U.S. election cycle, to the bond market internal mechanism. Notice the cluster around 3.5 to 4%. This tells you something very important. Most FOMC members expect policy to remain restrictive through 2025. There is no pivot to ultra easy money here, right? There's no return to 0%. We're not going back to 0%, and there is no rapid cutting cycles. But the futures market, represented by the blue line, remember, sits slightly below the median. What does that mean? It means traders believe economic weakness or disinflation will force the Fed to cut faster than its own projection. This is a classic market versus Fed battle. And historically, the market usually wins. The last time the Fed maintained a public narrative that contradicted market pricing this strongly was in early 2019. The Fed said hikes would continue. The market said no chance. Within a month, the Fed capitulated and started cutting. And no choice. The outliers tells a real story. Now let's look at the outliers. With the dots above and way below. Some policymakers believe inflation will remain stubborn and sticky, necessitating rate close to 4% all the way to 2028. Meaning we need to keep the rate high to fight inflation. Others believe the Fed will need to slash aggressively, with some projection dipping near or just above 2.5%. Some of these people actually want to be next Fed chair. You tell me what is driving their thoughts. So this range, this disorder reveals a Fed that does not have a unified model in the U.S. economy. They don't know what's happening. Or at least they have different views of what's happening. The range, this disorder, reveals a Federal Reserve that does not have a fully unified model. When central banks lose forecasting cohesion, right, market volatility increases because no one knows which faction will dominate going forward. And that's a problem. The outliers today are flashing a warning. There is no unified vision of where neutral interest rates really are. And what the market is pricing, the blue line, the market lines, as a subtle towards drift from 2025 toward the longer run. The downward slope represents expectation of slower growth, expectation of cooling inflation, expectation of eventual rate normalization, and importantly, expectation that the Fed will not be able to sustain restrictive policy without damaging the economy. That is perhaps the most important insight of the entire chart. The market believes the Fed long-run projection is too high for a post-pandemic, structurally fragile economy. We've got to cut the rates. Wall Street thinks the new neutral rate is lower than the Fed assumption. The Fed thinks the economy can tolerate higher rates for longer. This is not a small disagreement here. So what happens if the market is right? If the market is right, and the blue line represents reality, the implications are profound. Bond yield will continue to drift downward. The equity market will behave more aggressively than the Fed expects. Housing could stabilize sooner than policymakers anticipate, and the dollar could weaken. The Fed will be forced to abandon its higher for longer messaging. What happens if the Fed is right? What happens if the Fed is right? That's the question. Well, you have to flip it. Right? Essentially, if the Fed is right, rates stays higher for longer, bond markets will be mispriced, the stock market could face multiple contraction, inflation expectation will remain elevated, and the longer run rate near 3% becomes the new normal. So why this dot plot is a turning point? Well, this chart is not simply a forecast, it is a battleground. You are watching the beginning of a credibility cohesion between the Fed Reserve and the financial markets. The Fed is projecting a slow, controlled descent toward 3%. The market is projecting a faster, more urgent return to lower level. One of these two views will be wrong. So key takeaway from this dot plot is that uncertainty is rising. This is another example. We are having issues with uncertainties. We are having issues with the Fed is redoing. We are having issues to what is going to happen next. And that, my friend, you need to worry about.